Hey everyone, welcome back to Advanced Accounting. In last class, we talked about intra-entity inventory transfer. And in today's class, we're going to talk about another two major kinds of intra-entity asset transfer, which are intra-entity NAND transfer and intra-entity depreciable asset transfer. First, let's look at intra-entity NAND transfer. If you still remember that for intra-entity inventory transfer, we have three consolidation entries: entry TL, entry G, and entry star G. For intra-entity NAND transfer, we have two consolidation entries, entry TL and entry star GL. So basically, we have the year of transfer, which is between the parent and subsidiary. So it's either the parent transfer a NAND to the subsidiary or the subsidiary transfer a piece of NAND to the parent. So let's just assume here it is a parent to subsidiary downstream transfer. In the year when this transfer happened, we need to make the consolidation entry TL. And in any of the year before this piece of NAND is eventually transferred by the subsidiary to the outside party. So in all subsequent years, we have entry star GL, and that is the version 1. So we have two versions of the star GL entry. We use version 1 in all subsequent years until the year when this piece of NAND is eventually transferred out to the outside party. So year of sale of NAND to outside. So in the year, all of the subsequent year until the year of, so in all of the subsequent year until the year of sale, we use the first version of the star GL entry. And at the year of sale, we use the second version of star GL entry. And after this piece of NAND has been sold to the outside party, we don't need to make any consolidation entries after that. So this is basically how it works. And then we're going to look at how TL entry looks like and how the first version of star GL look like, as well as how the second version of star GL entry look like. So the TL entry, the purpose is to eliminate the effect of intra-entity transfer of NAND. And the entry is to debit gain on sale of NAND, credit NAND. Later, very shortly, I'm going to use an example to explain how we derive this consolidation entry. But here, just to give you an idea, so this is how the entry looks like. For the star GL entry, star subsequent entries, they're just referring to the same transaction. So the star GL entry, the purpose is to eliminate the gain on NAND transfer which occurred in a previous year. And then the entry is to debit retained earning of the seller. So if it is a downstream transfer, the seller is the parent. If it is upstream transfer, the seller is the subsidiary. As long as the NAND remain on the book of the buyer, the unrealized gain must be eliminated at the beginning of each subsequent physical period. So we're just going to talk more about it later when we use the example. And then, so here is an exception. If it is a downstream, the parent used the equity method with debit investment account instead of retained earnings. So this is the same idea as what we did in star G entry. So as a summary, we have a 2x2 situation again. All of these situations, except if the parent is using the equity method, it is a downstream transfer. Those entries are basically with debit retained earning at the beginning of the year for the seller. So if it is downstream, the seller is the parent. If it is upstream, the seller is the subsidiary. And we credit NAND. The exception is in this situation, if the parent used the equity method, if it is a downstream transfer, we debit investment account instead. So start GL entry at the year of sale. So this is the second version of the start GL entry. In the year of sale, because the land is eventually sold to the outside party, so we need to reverse back the previous deferral of that part of the gain. So if you look at this TL entry, basically it is by debit gain on sale of land, where in essence we're deferring the profit of this intra-entity sale of land. And then when can we recognize it? It is when we're able to sell the land to some outside party. So we need to, so this entry is the same as start GL entry version 1 that we talked about a minute ago. And the second entry is basically a reversal of TL entry. So if you look at here, our TL entry is to debit gain on sale of land, credit land. To reverse it, we basically debit land, credit gain on sale of land. So this is how we reverse the previous deferral. And then here, land cancel out. So what you have, if you combine these two entries, we're going to get debit retained earning for the seller and credit gain on sale of land. So this is the combined entry. And of course, the exception still applies here. If it is a downstream, the parent use the equity method. We debit investment account instead. So this is again the 2x2 situation. For all of the other three, except the equity method and downstream, that is essentially we debit retained earning of the seller and credit gain on sale of land. So if it is downstream, the seller is the parent. If it is upstream, the seller is the subsidiary. And then the exception is if the parent is using the equity method and if it is downstream, we debit investment account instead. So those are the general entries. Now let's look at an example that can help us better understand how those general entries are, specifically how they're derived. So the setting here is Hastings sold land that originally cost, so the original cost of the land is 60,000 and Hastings sold it to Patrick, its subsidiary, for 100,000. So this transaction happened in 2016. And then in 2018, Patrick sold the land to the outside party for 115,000. So this happened in 2018. Suppose Hastings used the initial value method. What are the consolidation entries to eliminate the effect of intra-entity land transfer in each of the 3 years, 2016, 2017, and 2018? So for each of those 3 years, we need a consolidation entry. Please take 5 minutes, try to work on it on your own. You can pause your video for now. So let's first look at the year of 2016, which is the year of transfer. If we have Hastings, which is the parent, we have Patrick, which is the subsidiary. Oh, sorry. And then we have Hastings plus Patrick. Which is if you view two firms as one firm. So on Hastings' book, what do you think is the journal entry that should be done by Hastings in the year 2016? Hastings sold a piece of land that originally cost 60 to Patrick for 100. Yeah, so Hastings gets cash 100, right? And after it has sold the land goes down by 60. So that is like, how much gain is it for Hastings? That's 40,000 gain for Hastings. And then how about Patrick? Patrick paid 100,000 cash to buy a land. So that land, piece of land is valued on Patrick's book for 100,000. And then if you look at two firms as one firm, is there anything happen within that year? If you look at two firms as one firm, actually no land has been sold to the outside party. So nothing happened during the year. So what we need to do is we have Hastings' book, we have Patrick's book. And then we need to make them as if two firms are one firm. So what do we do here? Cash actually, Hastings get 100,000, which is paid by Patrick. So if you look at two firms as one firm, like no cash goes out or goes in. So cash is correctly stated. There's nothing we need to do with regard to cash. Land was originally valued at 60, and because of this intra-entity transfer, now it is valued at 100. So if you look at two firms as one firm, this land is, because of this transaction, the land is overvalued by 40. So what we need to do is to write land down by 40,000. And then the gain. So because of this transaction, Hastings is able to recognize 40,000 gain on its book. Patrick didn't sell the land, so Patrick didn't, there's no income effect for Patrick. If you look at two firms as one firm, it hasn't sold the land yet, so no gain or loss should be recognized. So this 40,000 gain is actually, it is an overstatement. This is your TL entry. So this is in the year 2016. And then what do we do in the year 2017? So let me just write the entry again. In 2016, so the entry we have is TL entry, which is to debit gain sale of land for 40,000, credit land for 40,000. And then in the year 2017, which is 1 year after the year of transfer, but in the year 2017, Patrick hasn't sold the land to outside party yet. So what we need to do is just we need to carry over the effect of this 2016 entry, because this entry is done on the consolidation worksheet. It is not done on the parent book. It is not done on the subsidiaries book. So on the consolidation worksheet of the next year, we need to make this entry again to carry over its effect. And because gain on sale of land is an income statement effect, it should have been close to retained earning at the end of the year. So instead, to carry over the effect of this journal entry, instead of debit gain on sale of land, we cannot go back to debit this account again. Anything, if we debit gain again, it will be counted as current year income. So which doesn't make sense. So for any of the income statement effects, what we do here is we replace them with retained earning. So instead of debit gain on sale of land, we debit retained earning. for hosting 40,000 and credit land. So it's basically the same journal entry, just I replace all of the income statement account with retained earning. And because this is a downstream transfer, so we debit the parent's retained earning, and the parent is hosting. So this entry is called star GL entry, and specifically, this is the first version of star GL entry. And then, so what if the parent is using the equity method here? If the parent is using the equity method, so let's just look at here. So what if the parent is using the equity method? If the parent is using the equity method, instead of debit retained earning, we simply would debit investment account instead. So this is in the year 2017. And if Patrick hasn't sold this piece of land to the outside party until 2025, every year, 2017, 2018, 2019, so every year we just make this exact same journal entry again and again until the year the Patrick sells the land to the outside party. Then we need to switch to the star GL entry version 2. So in this situation, we're assuming year 2018 is the year that Patrick is eventually selling the land to the outside party. So there are actually two things happening here. First, we need to repeat the star GL entry, the first version, which is what we have been doing up until this year, which is to debit the seller's retained earning and credit land. So this is to carry over the previous year's effect. And then we need to, because in this year, the land is eventually sold. So now we can recognize that part of the deferred profit. And then to recognize it, so there are two ways to think about this issue. Be viewed as a reversal of TL entry, which is to debit land, credit gain on sale of land for 40,000. So this is one way to think about this entry. The second way to think about it is just to write out all of the journal entries. We have the parent subsidiary and parent plus subsidiary. Now the land has already been transferred to Patrick's book. So when Patrick eventually sold this piece of land, the parent doesn't need to do anything on its book. And when Patrick is selling this land, it gets cash 115. The cost of the land for Patrick is 100. So the gain for Patrick is 15,000. However, if you view two firms as one firm, it is selling the land for 115. The cost is 60, which was the original cost when Hastings was purchasing the land. And then the difference is 55. So in order to get from this to when two firms are viewed as one firm, there's nothing we need to do regarding with cash. Cash is correct here. So the gain on sale of land on Patrick's book, Patrick only recognized 15,000 when it sold the land, but actually for two firms as one firm, the profit it can recognize is 55. So we need to recognize another 40,000. Land. So when Patrick sold the land decreased by 100,000. But if you view two firms as one firm, the cost of the land is only 60. So we need to mark up land by 40,000. So this is again, so those are just the same entry. It will give you the same entry, no matter which way you are doing it, no matter how you think about it. So both of it will give you the general entry of debit land of 40,000, credit gain on sale of land for 40,000. So those are the two entries that form the star GL entry version 2. And then net cancel out. So the only thing you have is debit retained earning of Hastings 40,000, credit gain on sale of net for 40,000. So this is how start GL entry, the second version, is derived. And we use this version of the GL entry in the year that the net is eventually sold to the outside party. So we have talked about entry TL and start GL. The last thing I want to mention here about the intra-entity net transfer is if it is an intra-entity net transfer and there's non-controlling interest here, so basically we just do the same thing as what we did for the intra-entity inventory transfer. If it is downstream transfer, it have no effect on non-controlling interest. So in other words, when we're trying to decide how much of the consolidated net income to allocate to non-controlling interest, if it is a downstream transfer, we don't need to take out anything. Versus if it is upstream transfer, we need to exclude the intra-entity gain from subsidiaries' net income. So if you still remember, we use subs, so non-controlling interest share of the income is subsidiaries' net income minus amortization. If it is downstream transfer, it's it. And then we multiply it by the percentage of non-controlling interest, percentage of ownership. But if it is upstream transfer, we need to take out intra-entity gain. So we need to take out the current year intra-entity gain, but we need to add back the reversal of the previous year's gain here, and then multiply by the percentage of non-controlling interest. So this is the same idea as what we talked about last class when we talk about intra-entity inventory transfer.